Hey folks, Vic here with your weekly video. First off, a big thank you to all those who took advantage of our deeply discounted offer that we've never offered before. It was really well received, and that offer was made in response to one of the feedback comments that we received from our past and present Coaches Corner member survey that we did. I also received several emails asking if this could be extended due to various circumstances that people had. So we just figured rather than extending it for just a few people, we'll just extend the webinar special pricing for everyone. So if you didn't get in on it this last week, there's still time. Have until September 25th, and I provided a link in the text below this video or in the email that you received. Okay, one of the concerns that we often hear is that a person who wants to learn to trade the Forex markets simply doesn't have a large enough account size to take on some of these very lucrative longer term trades. And actually, the best way to start anyway is with a smaller account size. Learn to do things right, then you can add more money to your account once you have you've proven some positive consistency. So in this video, I'm going to show you how you can trade whatever style you like, long term or short term, with a smaller account size, say $500 or even less. Okay. If you like this video, we'd sure appreciate a thumbs up by hitting the like button, and of course be sure to subscribe to our channel by clicking the button in the lower right corner of the video. So let's now take a look at trading any style you like, short term, long term, whatever it is, even if you only have a small amount of capital to begin with. Okay, so I'm going to show you a trade example of how to trade any style of trading, even with a smaller account size, and specifically how to take longer term trades with a smaller account size, because obviously it's not a problem taking short term trades with a smaller account size, right? Because our short term trades are usually like 15, sometimes 10, many times 10 pips, 15 pips, 20, maybe 25 at the most. But first I need to give you some basic information so that what I say hopefully makes sense. So please bear with me, because like what I'm about to say is critical to understand. It's going to take a few minutes. I made a simple little PowerPoint, so I hope that helps you. Let me just bring that up right here. And so in our services, we have both long-term and short-term members, okay, short-term traders. The only difference between being a short-term and a long-term trader is the time frame combinations used for finding trading levels and trade setups. And normally the entry time frame for longer term trades is going to be either the daily or the 4-hour charts, depending on whether it's a position trade or a swing trade. But the trading approach is identical for both, right? Both long term and short term. For longer term trades, obviously the stops are bigger because we're using monthly and weekly charts to find levels for trading at. So here's the issue. No matter what your trading style is, we recommend no more than about 0.5% account risk on any one trade. That's pretty small, right? And we have it that way for a reason, and the reason is capital preservation, because capital preservation is everything. If you don't have money, you're done. So what if the account size is only $500? Well, if you have an account size of say $500, 0.5% is only $2.50 on a micro lot, which, by the way, micro lots are what we highly recommend trading while you're learning. There's no point in trading anything bigger than that until you've got it consistent. You got your trading going consistently. Okay, so that's about 25 pips. But our longer term trades can sometimes have pip risk of say up to 200 pips. Well, that would represent about $20, which is about 4% of your account. That's getting to be a bit much. You don't want to be, taking chunks of your account out like that. You simply just don't want to be thinking about taking on that kind of risk if you want to last in this business, okay? So how do you take the trade on? What can you do about that? Well, very simply, what we do is we wait for the desired level to be hit, like for the longer term trade, where we would normally enter a longer term trade, and instead of entering on a daily or a 4-hour time frame, we drop down to an hourly chart. And actually, I have a video tutorial on exactly this strategy as one of our bonus videos for our members. And Darko, just this past week or so, provided another one of them, a very detailed strategy for using higher time frame trend together with hourly charts for entry. Okay, very powerful. And then the other option is to simply risk more than 0.5%. Listen, we're not the Forex police here, okay? We just recommend the kind of risk exposure that we do. And we do it because it's very safe and it allows you to stay in this game for a long time. But with a smaller account, you may very well elect to take on more risk, say 1 or 2%, okay? And I mean, it's always up to you. That means you could risk $5 to $10 per trade with a $500 account if you're okay with this. But what you'll want to do is, as your account grows, you're always going to want to reduce the risk back down towards that 0.5% mark. At least that's what we would recommend. Okay, obviously it's ultimately up to you. So let's take a look at a trade here, and I'll show you how we can apply this concept. So let me just bring up my my charts here, right there. And I'm not going to go over a bunch. I just want to show you the concept of how to do this. So let's take a look at this is the Euro Swiss pair here. And in this pair, in this case here, you can see this is the monthly chart on the left, upper left. This is the weekly chart on the upper right. The daily chart is on the lower left, and you can see they're all heading down. Okay, everything's very, very negative. And and by the way, Darko covered this in his little tutorial that he did. This is one of about a half a dozen examples that he showed while he was explaining how to use this idea together with weekly and daily trend going in the same direction. So so like I say, that's all heading down. And then he'll be what he's going to do is he'll be pointing these trades out from time to time when he sees them. Okay, he won't be constantly, on there showing these trades, but if he sees them, he'll point them out. So monthly, weekly down, identical necklines. You see this weekly chart here. There was a price stopped here and then traded below it. On the daily chart, it's that same level right here. See that? So that's pretty good. And then price, see how price broke below it. That's what we're looking for because we want to be selling. We're in a downtrend. Okay, so monthly, weekly down. We have the identical necklines, and on our 1 hour chart, I have to go back to where that was right here when price broke below it. It rallies and breaks. You could have actually sold this first rally back up. The nice thing about when it came down the second time here, just to give you a little bit of a heads up on things, what happens is that most of the action is below this level rate. See this is a very strong level here, and you've got like about a 60 pip stop loss on this, but about a 90 pip drop below here. Now that's really good. It's just showing that most of the action's below here. So a 60 pip stop is what, $6 on one micro lot. So on a $500 account, you could certainly trade one of these, probably two, And but also notice that, like I say, price was mostly trading below this significant neckline. As for take profit, now we're into the trade management. Lots of ways to manage a trade. For example, take some profit at 1-to-1 reward risk, or at least remove the risk when you get to 1-to-1, or go for an opposing level. This is an opposing daily level, this black horizontal line down here. In this case, the opposing level was hit for a profit of 145 pips. That's pretty good on a 60 pip risk. Right? Now, if you scale out, you don't get the full reward risk, but I'm just pointing these out for educational purposes. But I just merely wanted to show you the idea of how a smaller account size, you shouldn't be turned off for long-term trading just because you have a smaller account size. It can be done, and you can certainly trade longer-term setups the way I just showed you. Okay, it just takes patience, okay, and to wait for a setup that you can afford to take that makes sense from a risk point of view, risk-reward point of view. And you'll find that some of these trades only need like 20 pips of risk. Sometimes they set up really, really sweetly. So if you're trading a longer term trade with only a 20 pip risk, you can imagine, and if it gets going for you, you can imagine that the reward risks are going to be huge. Thanks so much, folks. I hope you found that helpful, and you can see that a small account size shouldn't turn you away from taking on some of these very lucrative longer term trade setups. Okay, and again, the webinar special is still alive until Sunday, September 25th, so take a look at it. I would love to have you with us if it works for you. And we'll leave it at that. Thanks again for listening in. Hope you all have a great weekend and week ahead with your trading. All the best.